All right, so give us your take. What did you make of what we heard from Alphabet?
So indeed, search came in at 2% growth, $1 billion higher. But I think you also have to look at the fact that the network business, where they place ads on third-party websites, came in about 600 million lower year on year. And what happened, in our view, was that Alphabet probably didn't place ads on third-party sites, but instead kept those ads in-house, leading to the better search results. You also saw that YouTube was down for the third quarter in a row, which obviously shows that that property is not bulletproof, but indeed they're taking some of the most attractive users out of the pool of advertising inventory because the area that's growing faster for them is YouTube subscriptions like premium and music.
All right, certainly something to watch there. So, Richard, just stick with us just for a second. We're obviously just getting started when it comes to tech results, because after the close today, we get another look at the ad market, this time with Facebook parent Meta Platforms. Our Julia Boorstin has a look at the one metric that investors should be watching.
Mark Zuckerberg declared this the year of efficiency. So now the question is whether a slimmed down Meta can accelerate revenue growth. Earnings per share are expected to fall by 25.5%, while revenue is expected to decline by nearly 1%. Now, beyond a focus on top line growth, investors are interested in hearing more about the impact of ad market weakness, Meta's progress monetizing Reels and Messenger, as well as the company's AI and metaverse investments. Evercore warns, quote, one key headwind that remains is the persistent ad winter. And so far, we see no signs of recovery on that front. But we think Meta's scale and data advantage should make it a somewhat resilient platform. Year-to-date, Meta shares are up 73% as the company has outperformed its peers and the broader market. And despite those gains, analysts are still bullish. 71% have a buy rating and 20% have a hold. Frank, back over to you.
All right, that was our Julia Boorstin. Richard, back over to you. I want to get your take on what you're looking for and expecting out of Meta.
Sure. I think there's been a lot of hype about Reels. And indeed, just like a few years ago, there was an enormous amount of hype about the metaverse, but not enough focus on two things. One is on margins, because both Reels and the metaverse will be substantially lower margin businesses than Facebook enjoyed in the past. And second, as has been pointed out, and we've been talking about, I think, with you since fourth quarter last year, this recessionary impact on ad sales. And indeed, you saw that as well at Alphabet, where they're really focused on efficiency gains. The margins were down 90 basis points year on year because the growth is coming from areas like subscriptions and cloud, which are inherently lower margin businesses. So the question for Meta, not only are they in the next 4 months going to be shedding another 10,000 staff, which is hugely disruptive to the business, but the real question will be, what's the steady state margin profile of the business when they have Reels and Metaverse as their key drivers of growth, as opposed to the behavioral targeted ads that they'd been enjoying in the past, which had spectacular margins, the likes of which the internet sector had never seen before.
You know, a lot of discussion about Reels, monetizing it and maximizing the profitability of it. But I actually want to turn our attention back to Alphabet for just a second. So I'm looking at the stocks this morning. Alphabet is up 1%, but as you see, Microsoft's up 7%. Did Sundar Pichai, did he say enough about AI on this call? Microsoft really focused on AI. Did you hear enough about their AI plans, what they're going to do with Bard, and just their plans moving forward on this call?
This is something we've been talking about since the start of the year. And that Google's issue is that they have the brightest minds in AI. They have the rock stars. They have a third of the top 100 cited papers in AI, but they're an engineering-led company, and they have not productized what they've done. Whereas Satya Nadella at Microsoft has said, we're going to put AI in Office in front of millions of workers around the world every day. Allied to that, Alphabet has an issue with the fact that Android has been losing share. The Android smartphone vendors are not doing particularly well. So their mobile distribution footprint is shrinking. And what we really need to see out of Alphabet is them to get on the front foot and productize what they have done in AI and turn it into real applications that consumers can see value from, and indeed enterprises can see value from. I think your previous guest had mentioned that as well. They are seeing the expected slowdown in their cloud business. They need to make their incredible AI prowess and brain power inside Alphabet relevant to the products that they sell, not just improving their own internal operations.
All right, so with all that said, before we let you go, Google Cloud turning a profit for the first time. Big deal or not a big deal?
Not as much of a big deal, because if you looked at the fine print of how they reallocated corporate costs this year at Google, they removed $1 billion of cost last year that was allocated to Google Cloud and allocated it instead to the services business and the corporate parent sort of overhead. So they gave themselves a little bit of a tailwind boost. And let's see if, as they are folding the chipset business and DeepMind into cloud and into services, let's see if they don't add some costs to pursue the growth that they've talked about in cloud. A 3% margin in a business that's on a $30 billion run rate is somewhat of a rounding error, to be fair. And I wouldn't extrapolate that to say that it's off to the races to see the kind of margins we're looking at AWS in a few quarters' time.